We've just explored the macro changes shaping our world. But what do they mean for the markets? In this next session, our panelists will share with us some of the most exciting opportunities on the horizon, the critical risks to watch out for, and the key trends set to define the time ahead. Please give a warm welcome to our moderator, Julia Leung, from the Securities and Futures Commission, and our panelists, Mike Gitlin from Capital Group, Ted Pick from Morgan Stanley, and David Solomon from Goldman Sachs. Julia, over to you. Thank you.
A very warm welcome to our panel on markets. And I'm glad that I'm joined by three CEOs who need no introduction. I'm Mike, Ted, and David. Just now, Arthur's panel on macro economics trends set a perfect backdrop to what we are discussing. To borrow the summit's theme of tracking and shifting terrains, the terrains have indeed shifted quite a bit in the last year since we last met here. Our macro panel speakers have just spoke of trade tensions, refiguration of supply chain, the AI and the technology, the money that's been plowed into technology, and of course the regulatory landscape, which are moving in different speeds and moving in different directions. Against this backdrop, tracking is undoubtedly difficult, given the low visibility of what comes next. But when it comes to market, which is the theme of this panel, is almost paradoxical that these uncertainties have not dampened the party spirit. US equities are setting record highs, driven by AI, deregulation, and rate cuts. So are many of Asia's equities market. Japan's Nikkei and Korea's KOSPI has hit new highs. Shanghai Composite is in the highest in a decade, helped by easing US-China sanctions and softening of US dollar and growing diversification. Hedges and alternatives are also booming. Gold, silver, Bitcoin prices have been up sharply, so are private markets and structured products. So is it risk on or risk off, or it's just formal? Surely alarm bells have set off. Jay Powers of US Fed sounded caution on the US stocks valuation. Andrew Bailey of Bank of England was concerned about the rapid growth of structured products. And IMF warned of the potential for a sharp market correction. To borrow an English idiom, which is often used in Chinese in exactly the same term, some would say the risk-reward profile right now is like pulling chestnuts out of the fire. So would the proverbial cat's paws be burned? So that's why, gentlemen, here's my first question for your quick take. Is all this sustainable going into 2026? I'll start with Mike.
Well, thank you, and I appreciate being here. Is it all sustainable going into 26? We tend to think of 2036 more than 2026, but if you look forward, what are some of the things that are sustainable? AI deployment and diffusion, adoption, productivity will continue to get better. It will take a long time, but it will continue to get better. Diversification into non-dollar assets. We continue to see demand for non-dollar assets around the world. Dispersion in terms of corporate opportunities and company opportunities around the world for investment. We talked a little bit about deregulation. There's a positive growth impulse to that, and I think the economies, and Colm talked about this, and I always love presenting after Colm. It makes it so much easier, so thank you. If you look at the deregulation, I think that's a positive growth impulse. And last, earnings. Earnings are strong, and that's super important. What's a little more challenging are valuations. I think everybody in this room, if we looked at a pendulum or a scale and said we had cheap, fair, and full value, and you had a plot somewhere on there, I think the majority of people in the room would say we're somewhere between fair and full. But I don't think a lot of people would say we're between cheap and fair. So on a valuation perspective, that's challenging. And I think if you look at the credit markets as well, if you look at 30 years of data, we're in the richest decile of credit spreads. So stock markets aren't cheap, credit's not cheap, and there's speculation in both precious metals and also cryptocurrency. So I think on a near-term valuation side, there's some challenges, but there's some long-term sustainability in some of the themes.
Ted?
Yeah, I agree with everything Gitch just said. We've come a long way. There's still policy error risk. There's still geopolitical uncertainty. But you think about where we were a year ago sitting on this stage, new administration coming in, talking about re-architecting industrial policy and addressing these enormous fiscal and trade imbalances. And look at what's happened. In April, we had the height of the headwinds when we had DOGE and immigration and the bill being put through and tariffs if the courts hold them up. So we come to today, and yes, markets seem expensive, as Mike said, but the reality is systematic risk is probably narrowed. So if we were sitting here thinking last year about whether risk-taking in equities was itself problematic, now we're talking about valuation itself, which gets me to the same place looking into 2026, which is earnings. I think to the extent that companies are able to demonstrate on the back of pretty benign consumer and corporate data that they can inure the needed spend on AI and they can actually continue to build comparative advantage and produce good earnings, they're going to outperform. We're going to see that dispersion. Those companies that can't, they will underperform. But the new issue market is active around the world. Investors want to take risks, so I'd say the overall environment feels pretty good going forward. We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect, just the reality that, for example, metals have really run. I think that's a healthy development, and what we'll be looking to see in 26 is whether the market, in fact, broadens and we see that kind of dispersion.
So David, would you agree with them or not?
Well, going third is always easier because the two smart gentlemen on the stage have said most of what I would say on those topics. I mean, things I'd add just for perspective. In 1996, Alan Greenspan started talking about irrational exuberance in markets, and the Nasdaq was 1,300, and it peaked 3.5 years later at over 5,000. So when you have these cycles, things can run for a period of time. But there are things that will change sentiment and will create drawdowns or change the perspective on the growth trajectory, and none of us are smart enough to see them until they actually occur, and it won't be any different, this time at some point. Technology multiples are full. I'd say technology multiples are kind of 80th percentile in a historical context. But when you look at the broad market, there are lots of things where the multiples aren't as full, especially given earnings growth and kind of the momentum in economies. Most governments are running most developed economies are running very, very aggressive fiscal plays, and that underlies economic strength and forward momentum. And so I think it's a pretty constructive environment. Give you lots of things that could go wrong, but at the moment, those don't seem likely in the short-term distribution of outcomes.
Well, David, you actually, my next set of questions is about strategic asset allocation, which will be directed individually to you. So I'll start with David. You actually mentioned drawdown and Ted as well. Not recently, then you have actually say that you expect and predict a drawdown in the next 12 to 24 months. That's a very long span. What are the factors? I mean, maybe you can elaborate on the factors that trigger that drawdown. And you guys have avoided using correction or crash or something, but drawdown. So explain what is your advice giving your clients to prepare for that drawdown?
Our advice generally, the firm's advice for a long period of time has been to stay invested and look at your portfolio allocation and stay invested, and that advice has served people well. None of us are market timers. It's a little bit what Mike said. He's looking at 2036, not 2026. But if you believe in growth in the world, you have a portfolio allocation as a global capital allocator, and generally speaking, a 10 to 15% drawdown, which by the way happens often through even positive market cycles, is not something that changes your fundamental structural belief as to how you want to allocate capital. So, you know, when I made that comment at Italian Tech Week about a month ago. I said, and I don't remember how the question was framed, but the question was framed in a way where I said, of course, it is likely there'll be, you know, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. And I'd say there are very few people in this room that don't think that that's a meaningful possibility. It doesn't mean that the general direction of capital flows, investment, portfolio allocations changing. It just means things run and then they pull back so people can reassess.
All right, it's more like while the music goes on, then let's continue to dance.
No, I didn't say that.
Right. Ted, as a strategy to diversify, investors have increased allocation to alternative investments. Like Morgan Stanley has suggested between 15 to 20% allocation to alternatives. So which alternative assets in particular and private market seems to present a case of high risk, high reward, as seen in the First Brands bankruptcy? So how are you going to take advantage of these opportunities while mitigating the risk, or, so to say, avoid the cockroaches that your peer said?
Well, diversification, risk management, they all matter. Pricing, liquidity. The context here is that the private assets market has tripled to 15 trillion over the last decade. So there's been the real institutional branding of the product, and now it's come of age. Over the last 12 to 18 months, we've now begun to see, through deregulation and technology innovation, the democratization of those private assets for retail. And that is exciting, because the retail investor wants to have the opportunity to own a SpaceX, for example, in the years before it goes public. Private companies stay private for 14 years instead of 5. So some of that alpha is interesting to get to high net worth. If you look at our own allocation to private assets, we have about 5 trillion of non-self-directed wealth management assets in the US, and about 250 of that 5 trillion is in private assets across private equity, private credit, real estate infrastructure. That's about a 5% weighting, right? 250 over 5 trillion. And I would think over time, over the long span of time, that number could work its way towards 10%, but diversification will be important. And for us, we're open architecture. The 250 billion that we have is over 260 managers. We have product from these gentlemen's shops. We also have evergreen products where you can, on single ticket, a product we call PMAX, you can have a single ticket that gives you diversified coverage and investment to a broad array of strategies, so you are protected from the single CUSIP or single company experience. The other piece of this, of course, is the ability to trade those private assets, and there too, I think that's going to be an exciting development. There are products and companies like EquityZen that will be able to trade these private assets on a single name basis before they go public. That's interesting for those private companies as they look to grow into fees option plans, but it's also interesting for investors who want to be able to allocate not just funds across these strategies, but single companies too.
So diversification is still, diversifying from the public market is still part of the theme going forward.
Yeah, I think the theme is important, and importantly, when you think about some of the developments that folks on this stage are looking at, where they can have strategies that incorporate some of the best of public and private investing in a single product, that could be interesting. But diversifying amongst the private asset class and best of breed and having hygiene around diligence, really knowing where those asset managers have excellence is important, and then obviously layering into that over the long span of time. And then importantly, too, to be considering what your real liquidity preference is at the client level. And that's an education for the financial advisor, knowing their clients and what kind of liquidity windows they actually have, both for investing and then also for wealth transfer, tax optimization, all of that. The technology that is coming to age is pretty exciting around the ability to actually do that in an effective way at the individual investor level.
I certainly agree. We in Hong Kong are looking at hybrids, where on the retailization of private funds, then we are more like hybrids as a starting point for education. Let me turn to Mike, fixed income. So in this highly uncertain political environment and with fiscal debt, which our previous panel talked about being in a very high level for development markets, Some would say that they would avoid US Treasury. The fiscal debt situation has worsened, but none of you actually highlight it as an area for concern. But because everyone is talking about 2035, you started it. So, but I think corporate credits still, even though they're still fairly tight. So what kind of investor portfolio mix would you look at? Will there be a change in maturities that one should look into going into the near term, not 35, please?
Yeah. Well, if you look at fixed income, one of the things you do when spreads are tight is you go up in credit quality. So we're seeing a lot of interest in high yield from going from triple C's up to single B's and double B's, with investment grade going from triple B's up to single A and double A. Just go up in credit quality. The diversification benefits of fixed income are real. 2022 was an anomaly. It's very rare you have zero interest rate periods where rates go up 500 basis points very quickly. So those diversification benefits are real. If you look over the last 30 years in the public markets in a 60-40 portfolio, and the 60-40 portfolio's death is greatly exaggerated. If you look at the returns over that 30-year period, you've annualized 9% returns. Super good. Public market, transparent, liquid, relatively inexpensive, so benefits from those diversification. And then I think if you look at the macro environment, monetary policy is supportive. So if we look back 3 years and you're looking at returns in the fixed income market, corporate, core, high yield, emerging market debt, your annualized returns in these asset classes over the last 3 years is anywhere between 5 and 11%. So if you have 7% capital market assumptions, you're getting a long way there in your fixed income total returns, and your starting point in yields today is a pretty good indicator of your 5-year forward-looking return. So if the risk-free rate is still relatively high, fixed income still constructive. It doesn't mean spreads aren't tight. It just means all-in yields are relatively high, and if company earnings, like Ted mentioned, remain strong, it's still a constructive environment.
Thank you. My next set of question is about continuing on the theme of asset diversification, but we'll focus on geographical regions, and particularly China and rest of Asia. I'll start with David again. Goldman Sachs has been very active in China, and I just learned that you're flying up to Beijing after this morning's session. So since this DeepSeek moment, people are taking a different view on China, and given what's happened last week with the, what do you call, truce or trade pact between US and China, how are sentiments changing, and what would you like, and what would you see in the next few years?
I'll make a couple of comments around that. I mean, sentiment with respect to Chinese equities certainly had a lot of room to change. If you go back to a year ago, after what happened in 2020 and 2021 and 2022, kind of six trillion was wiped out. And so you've seen year over year since we were last year about an 80% move in Chinese equities, and that kind of makes up about half of what was lost during that, during that period. And I think it's reflective of whether it's the DeepSeek moment or just a more normalized kind of long-term view, and also just the fact that on a global basis with valuations moving up, a lot of these Chinese equities look very, very attractive. China is one of the largest, most important economies in the world. Global capital allocators will continue to be interested in China in almost any environment. I think what you've seen over the course of the last year is a little bit, after a shift away, a little bit of a shift back from global capital allocators. And my guess is that'll continue with this a little bit greater stability over the course of the next year versus what we've seen over the last 12 months.
I moved to Ted for the rest of Asia. You've seen actually the regional markets are actually growing very rapidly as well. That includes India, Japan, and Southeast Asia. So the MSCI Asia Pacific Index are up 20% this year. So we remain positive. Morgan Stanley remain positive on Asia in this region. So which are the markets which really excites you, and which are the markets which are more developed markets or more EM markets?
Well, I would echo David's comments. Hong Kong, China is where it begins and ends. The developments, if you believe in a market where investors will reward great companies and where dispersion matters, AI, robotics, EV, biotech, you have not just national champions, but global winners that are listing in Hong Kong, raising capital, and effectively establishing themselves as world's top 2, 3, 4, 500 companies immediately. So really, you start here. But as you look to in Japan and you start thinking about not just diversification across asset classes, but diversification across geographies, it's hard not to be excited about Hong Kong, China, Japan, and India, 3 vastly different narratives, but all part of a global Asia story. In Japan, you see the reawakening of investor interest and corporate governance, and there is a ton of corporate activity that is underway and will continue. And then you have in Japan the reality of demography and the very slow but inexorable move of yen plus real estate is a savings portfolio into something that looks like a traditional invested portfolio, and that's something we're very excited about. And then India has enormous infrastructure-led runway, will be one of the world's most deeply held markets once we see the kind of deregulation that we would expect over the next 5, 10, 15 years. So if you think about the next 5 years and we talk about the need to diversify as between risk and non-risk assets and between public and private assets, it really does matter now to have that geographic footprint in all 3 major locations. Very different narratives, but all should generate alpha and positive risk-adjusted returns over the next 3, 5, 10, 20 years.
So Mike, a year ago, or even before then, we're talking about the growing power of passives, and passives ETFs been like dominated. New money is going into passive. But now it seems that it's moving to active and active ETFs again. Maybe you explain a little bit about that trend change and where would it lead to and how should Asian investors benefit from it?
Yeah, I think what's starting in the US is expanding globally. If you look at ETFs, it's an investment vehicle. For 30 years, we let the vehicle be described as passive because there weren't active alternatives. Now that there are active alternatives, the adoption rate is much faster than any of us would have imagined. I'll just give you a sense for us. We launched active ETFs in the US 3 years ago. We reached $100 billion of assets this week. And the flow rate is about $1 billion per week. So the interest in getting those active outperformance in the ETF vehicle that's so well desired, again, in the US for mainly tax reasons as well, but globally the vehicle adoption's growing. I think what you'll see over time is that installed base, so back to the US ETF market, 90% still passive, 10% active. The flow rate is about 35 to 40% into active. So over time, 90-10 will be 80-20, 70-30, et cetera, just for the opportunity to be able to gain the intellectual capital in a different vehicle other than a mutual fund or a separately managed account or a collective investment trust. It's just a vehicle of choice mentality, and the adoption rate tends to be high when you offer the vehicle that consumers want.
We have enough time for one more question for all 3, a quick response. We've been talking about the trillions or hundreds of billions of US dollar plowed into AI, but we're not seeing, and the return will be spread out maybe 10 years, 2035. So, but in between, the investors might be, as the proverbial cats, they might get burned. So your assessment of the potential shock to our system, what is your assessment in the next 2 years, not 10 years? And also, where is the biggest crack? That is Mike first, and then go all the way.
When you look at AI in general, I think of it on a continuum, and Gen AI in terms of augmentation and making people more efficient. You go out to agentic AI, robotic AI, quantum computing. The world is pricing AI as if it's further along that continuum than it really is in terms of actual effectiveness today. So I don't think there's a huge debate in that. Everyone uses the term overestimating the impact in the near term, underestimating the long term. While I believe that, the valuations today would suggest there's a lot built in to future expectations.
Ted?
Yeah, I agree with that. There'll be some capital misallocation, but it's here, and it will transform itself from something that is an efficiency tool to something that is intrinsically an effectiveness tool, and it's something where the genie's not going to be put back in the bottle. And as such, will actually, at the risk of crowding out investment in the short term, be something that could power global growth for a long time.
David, you have the last word.
I agree with what my colleague said. It's a journey. You know, there's a lot of focus right now on data centers and chips and compute, and some very smart people I talk to are focused on a lot of value being created in applications and the application layer. But whenever there's excitement about a new technology, and this is real, you know, people believe the opportunity, and generally speaking, things run ahead of the speed at which it ramps up. My guess is we'll see some of that here. But in the long run, these are really, you know, interesting opportunities, and a lot of capital will be winners and losers, just as there always has been. And, you know, we'll experience that in the coming years.
Thank you. That remains for me to thank our speakers and in this very agreeable panel, and for all of you to put your hands together to have had.